the selling of Japanese institutions' interests came at a very difficult time for the US market, because it was about that time there was some disappointing earnings coming through from, the Magnificent Seven, the top tech companies. And so you had this combination, if you like, which was driving down equities. And it is a crisis. And I think it's very much akin to the crisis that we saw, well, our grandparents saw in 1929. You have the first leg, where there is the panic. The panic subsides, the authorities come in, and in late 1929, the Fed actually did pretty much what it would do today. It went into the market and bought US treasuries to keep interest rates down. It made reserves available for the commercial banks so that their balance sheets they will do the same. They will have to panic and cut interest rates. My guess is after we've seen something like a 30 to 40% fall in the S&P, they will cut interest rates. I can see the meeting, emergency FOMC meeting today. When that happens, I think markets will steady. This is what happened from around about November 1929 and ran through to around about May to June in 1930. Then the market started its pernicious decline from having rallied about, regained about half the initial fall. You then had this long, pernicious decline down to a low level where the Dow fell, roughly lost 90% or 89% from the top by mid-1932. I won't describe the crises that came with it, like banks failing and all the rest of it. This is the sort of thing which, we can envisage being repeated today. But you can see that the structure of the market, of the bear market, is actually quite clear in advance. We can see this in advance. So to summarize, you've got the initial crash where everybody throws their toys out of the pram. We all get terribly worried. Banks start worrying about the value of the collateral they've got against loans, all that sort of stuff. The Fed comes in, has to rescue the situation. Calm is restored for a number of months, and then the real decline starts.
The global financial system is showing signs of distress, and it's eerily reminiscent of the market conditions that led to the 1929 crash. Alasdair Macleod, a seasoned observer of economic trends, highlights the unsettling parallels between the current market dynamics and those of the late 1920s. As Japanese institutions began selling their foreign investments, particularly U.S. treasuries, at a time when U.S. tech companies, often referred to as the Magnificent Seven, were delivering disappointing earnings, a perfect storm was brewing. Macleod draws a compelling comparison between today's financial landscape and the first leg of the 1929 crash. Back then, the initial panic caused by the stock market's sudden downturn was temporarily alleviated by the Federal Reserve's intervention. The Fed bought U.S. treasuries to keep interest rates down and provided liquidity to commercial banks to stabilize their balance sheets. This approach, which echoes today's monetary policies, offered a brief respite. However, the real trouble began afterward, leading to a prolonged and devastating market decline. In both 1929 and today, the initial crash is just the beginning. The Fed's likely response, as Macleod predicts, will be to cut interest rates in a panic, especially if the S&P 500 experiences a significant drop of 30 to 40%. An emergency Federal Open Market Committee, FOMC meeting, could be convened to implement these rate cuts, which may initially stabilize markets. However, this would only be a temporary solution. History shows that after the initial crash and subsequent Fed intervention, markets might stabilize for a few months, giving investors a false sense of security. But this calm is usually followed by a more prolonged and severe decline. In 1929, after the initial crash, the market rallied briefly, recovering about half of its losses. One of the critical factors contributing to the current market instability is the growing disconnect between bond yields and equity valuations. Typically, towards the end of a bull market, rising interest rates and bond yields create tension between the bond and equity markets. As bond yields rise, the cost of borrowing increases, putting pressure on corporate profits and, by extension, stock prices. Eventually, this tension becomes unsustainable, and the market snaps. Macleod points out that we are currently witnessing one of the most significant disconnects in history between bond yields and equity valuations. The S&P 500 has continued to climb, even as bond yields have risen, creating a massive disparity. This gap, Macleod suggests, is now poised to close, and when it does, it could trigger a market correction of historic proportions. Japanese institutions have played a significant role in exacerbating this market tension. For years, these institutions sought higher yields abroad by investing in foreign bonds, particularly U.S. Treasuries, and equities. They leveraged the yen carry trade, a strategy where investors borrow yen at low interest rates to invest in higher-yielding assets abroad. This trade was highly profitable as long as the yen remained weak against the dollar. However, the Bank of Japan's recent decision to raise interest rates even slightly, from 0.1% to 0.25%, has triggered a reversal of the yen carry trade. Investors who had borrowed yen to buy dollars and invest in U.S. Treasuries and equities are now facing significant losses as the yen strengthens. This has led to a rush to unwind these positions, exacerbating the sell-off in U.S. assets. The unwinding of the yen carry trade has broader implications for global markets. As Japanese institutions liquidate their foreign positions, the selling pressure on U.S. Treasuries and equities increases, driving down their prices. This, in turn, puts further upward pressure on U.S. bond yields, creating a vicious cycle that could accelerate the market decline. The critical question now is what will trigger the final snap, the point at which the market's tenuous balance finally gives way to a full-blown collapse. Macleod suggests that the combination of rising bond yields, disappointing corporate earnings, and the unwinding of the yen carry trade could be the catalysts. The market is already on edge, and it may only take a minor shock to set off a chain reaction of selling. When this happens, the Fed will likely be forced to intervene again, possibly cutting interest rates further and injecting more liquidity into the system. However, as history shows, this will only delay the inevitable. The structural issues within the market, excessive debt, overvalued equities, and rising interest rates, will eventually lead to a more severe and prolonged downturn.
Individual events occur, and you're right, it's difficult really to assess the importance of those events until they play out. But I think by far the most important thing to understand in terms of market valuation is the disconnect between bond yields and equity indices. Usually what happens towards the end of a bull market in equities is that you find that economic conditions are such that interest rates have already started rising, bond yields have already started rising. A tension develops between the valuation of the equity markets and the bond markets, and it sort of pulls apart like that, and then suddenly it snaps. This is, I think, what we're seeing. If you chart the 10-year US Treasury yield, invert it and put it alongside the S&P, you will see that an inverted yield and an S&P generally correlate pretty tightly. There have been exceptions. The first big exception was the dot-com bubble, and in the years following that. The second big one was COVID, where with the suppression of interest rates to the zero bound, the yield on the 10-year US Treasury just collapsed down to less than 1%. The third one, which is the one we're in now, is the biggest disconnect in terms of valuation that we have seen in history. Now, it is closed a little bit with the yield on the 10-year US Treasury coming off a little bit, and at the same time, the S&P 500 itself coming off a little bit. So that gap has closed a little bit. We are now in the situation where having the S&P having continued to sort of climb while bond yields were climbing, that disparity is so great that the snap is now in place. It's just a question of what triggers it. And what has happened is that the institutions in Japan in particular over many years have sought higher yields abroad by investing in foreign bonds, particularly US Treasuries, and also some of the European bond markets as well. They have also invested quite a lot in US equities. So we have this situation where, with the outflows of capital accelerated by the carry trade, as individual institutions in the US and elsewhere would rush out and borrow yen in order to sell the yen to buy dollars and then invest the dollars in T-bills for a yield pickup, really, of about 5%, leveraged up so that your return on your underlying capital is probably 50% if you leverage it up 10 times. You can see how this thing was taken to excess. And this was why the yen rate against the dollar fell from around about 100 to about 161.5, which was the lowest level for the yen. The numbers are upside down, incidentally. You need to invert the chart. And then everybody got wind, if you like, that the Bank of Japan was going to change its policy and actually raise interest rates from 0.1% to 0.25%. Wow, what a shocker. But what it did was it triggered an avalanche of reversal of the carry trade, as suddenly there were huge losses on the capital side of the carry trade, particularly where people actually hadn't covered for the exchange risk. And at the same time, you were finding that the Japanese pension funds and insurance companies were making, they were facing quite big losses where they were going out into term debt. And so really what they were doing is they were trying to liquidate their foreign positions as the currency was recovering, because the currency was wiping out any profits that they had or making their bond losses even worse. So they were basically selling dollars, buying yen.
As we stand on the brink of what could be a significant market collapse, it's worth reflecting on the historical role of gold and silver as safe havens in times of economic turmoil. During the Great Depression, those who held physical gold and silver were able to preserve their wealth while others saw their fortunes evaporate. Today, as we face a potential repeat of that scenario, the importance of these precious metals cannot be overstated. Gold and silver have a long history of serving as stores of value during times of crisis. Unlike fiat currencies, which can be devalued by inflation and government mismanagement, gold and silver have intrinsic value that has stood the test of time. As central banks around the world continue to print money and drive up inflation, the purchasing power of fiat currencies is eroding. In contrast, gold and silver have retained their value, making them essential assets for preserving wealth in uncertain times. One of the key points Macleod raises is the disconnect between the price of paper gold traded in the futures markets, and the price of physical gold. The price of paper gold is often manipulated by large financial institutions, which can create an artificial supply by trading gold that doesn't actually exist. This suppresses the price of gold in the futures markets, even as demand for physical gold remains strong. This manipulation creates an opportunity for savvy investors. As the market crisis deepens, the demand for physical gold is likely to surge, driving up its price. Those who have invested in physical gold will be well positioned to benefit from this increase, while those holding paper gold may find themselves holding a devalued asset. The key takeaway here is that in times of crisis, it's not enough to own gold on paper. You need to hold the real thing. While gold often gets the most attention, silver is equally important as a safe haven asset. In fact, silver may be even more undervalued than gold, making it an attractive investment opportunity. Like gold, silver has intrinsic value and a long history of serving as a store of wealth. However, silver also has significant industrial uses, particularly in electronics, solar panels, and other high-tech applications. This industrial demand adds an additional layer of value to silver that gold does not have. Macleod highlights the fact that silver is currently being manipulated by a few large financial institutions, which are shorting the market to suppress its price. However, as the global economy continues to struggle, the demand for silver, both as an industrial metal and as a safe haven, will likely outstrip supply. This could lead to a sharp increase in the price of silver, making it one of the most attractive investment opportunities in the current market. Central banks around the world are not blind to these dynamics. In fact, they have been quietly accumulating gold at an unprecedented rate. This is not just a precautionary measure. It's a strategic move in anticipation of a major shift in the global financial system. As the value of fiat currencies continues to erode, Central banks are positioning themselves to weather the storm by holding large reserves of gold. This accumulation of gold by central banks is a strong signal to individual investors. If the institutions that manage the global financial system are betting on gold, it's a clear indication that you should too. By following their lead and investing in physical gold and silver, you can protect your wealth from the coming financial crisis and position yourself to profit from the eventual recovery. Practical steps for protecting your wealth. For individual investors, the current market conditions present both a challenge and an opportunity. On the one hand, the risk of a major market collapse is very real. On the other hand, those who take proactive steps to protect their wealth by investing in gold and silver can not only preserve their assets, but potentially increase their wealth during the downturn. The first step is to invest in physical gold and silver. This means buying bullion or coins that you can hold in your possession, rather than relying on paper gold or silver certificates. While these physical assets may require more effort to purchase and store, they offer the most security in times of crisis. Next, consider diversifying your investments by adding other tangible assets, such as real estate or fine art, which can also serve as stores of value. The key is to move away from fiat currencies and paper assets, which are vulnerable to inflation and market manipulation, and towards assets with intrinsic value. Finally, stay informed and be prepared to act quickly as market conditions change. The financial landscape is evolving rapidly, and those who can adapt to these changes will be the ones who thrive. In conclusion, we are facing a financial crisis of potentially historic proportions. The warning signs are all around us. Rising bond yields, overvalued equities, and the unwinding of the yen carry trade are all pointing towards a market collapse. However, by taking proactive steps to protect your wealth, such as investing in physical gold and silver, you can not only preserve your assets, but also position yourself to profit from the eventual recovery. Gold and silver have stood the test of time as stores of value, and in the current market conditions, they offer the best protection against the coming storm. Don't wait for the crisis to hit. Take action now to secure your financial future. As a parting thought, remember the words of J.P. Morgan: "Gold is money, everything else is credit." In a world where credit is increasingly unstable, gold and silver are the true safe havens.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.